A very warm welcome to our special webinar, Financial Planning, the Blueprint of Your Life. As we come together on the eve of our National Independence Day, it's the perfect time to reflect on the idea of a freedom, the financial independence. Today, we will explore how a well crafted financial plan can guide you towards stability, growth, and the achievement of your long term goals. Just as on our national independence was built on vision, determination, and careful preparation, your personal finance freedom begins with clarity, discipline, and a strategic plan. So let's embark on this journey together and discover how to create a secure and empowered financial future. So for this webinar, we have with us Mr. Suresh Sadgopan, Managing Director and Principal Officer, Ladder 7 Wealth Planners Private Limited. Mr. Sadgopan is a SEBI registered investment advisor with over 2 decades of experience in the personal finance domain. He has helped numerous individuals and families to achieve their financial goal through unbiased, client centric advice. Mr. Sadgopan is a CFP certificate and a respected voice in the financial planning community, frequently contributing to leading business publication and speaking at industry forums. His expertise spans goal based planning, risk management, retirement strategies, and investment advisory. Known for this practical and ethical approach, he is passionate about enhancing financial literacy and empowering individuals to make informed money decisions. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels, aims at enhancing the quality standards in securities markets. Now, before beginning the session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on the NISM YouTube channel. Now I request Suresh sir to begin with the session.
Yeah, thank you so much, Sahil. Thanks so much for inviting me to this session. It's a very special session on the eve of Indian Independence Day, and today I'm really going to talk about financial planning and how it can actually deliver independence in life. Because finance is a very important part of our lives, and I mean achieving independence here actually delivers a whole lot of freedom, clarity, uh, and peace of mind. So let us get into this session. Uh, I want to tell you a few things before we get into this session. I want to do the context setting. So I mean, financial planning is a very vast subject. So in this thing, I will not be able to, in this 45 minutes, I'll not be able to uh, do full justice to this. So what I'm going to do is I'm going to share a few things which are very important for you. Any of you who are attending the session, whether you are right at the beginning of your career, you are somewhere in the middle of your career, whatever be your goals, I mean, the principles of financial planning are still the same. Okay. So I'm going to lay out that in a sense, we are actually going to open out our toolkit, and we are going to show it in front of you so that you can actually take up some of these and you can implement it in your day-to-day lives. So whether you have a planner or otherwise, you can actually benefit from what financial planning can offer you. So I'm sharing the screen right now. Are you able to see this now?
Yes, sir, yes.
Yeah. Uh, yeah. So financial planning, the blueprint of for your life. So that is the session. That is what the session is called. Um, Yeah, I mean, we are all materialistic today in the world, and being materialistic is nothing. It's not a bad word. Money is very important in our life, but life is not all about money. Money is not the destination. Money is a means to a certain destination that we want to where we want to reach. So we need to still find the purpose, and money is very important in life. So with that preamble, let me start with the session. So let us actually understand what is this thing called financial planning. I'm going to give you two definitions for this. Very simply, it is managing available resources prudently to meet whatever goals. Each one of us in life, we have certain goals which we want to meet. And for each of us, it can be something different. I mean, there are a lot of goals which are going to be very, very similar. Like somebody wants to plan for retirement. So that is there for all of us. All of us have to ultimately eventually retire. We will all want to have a house of our own, a comfortable house of our own. We may want to plan vacations. We may want to plan for our children. Those of us who have children, we may want to plan their education, future, and so on. So these are some of the goals which may be there in a person's life, and we need to properly plan for it. So financial planning is the architecture that we put together so that whatever available resources are there, it is available to you to meet the goals at the appropriate time. So very shortly put, that is what it is. The other way of looking at it is, where are you today, where do you want to go, and how to get there. So that's the blueprint that we will create, that is a financial plan. So two very, very simple definitions I have put in front of you. So let us dive into financial planning a bit more. See, the unfortunate part as far as finances are concerned is that everybody wants money, but nobody really pays too much attention to managing money or anything to do with money. So we plan a lot of things. Like if there is a birthday in the family, if there is a marriage in the family, even if it is a day out, we plan everything to the T. We plan it very, very carefully. But finance is an area which we typically tend to leave out, which is ironical because we are working for it for 30 to 40 years. Most of us work for that duration of time to get the money so that we can meet the goals, we can be in comfort, we can accumulate wealth, we can pass on a legacy. There are so many things that we want to do. So it's very ironical that we are not really paying too much attention to our personal finances, and we are not doing any planning in the area of finances where in every other area we are so very attentive. So financial planning, very simply put, is a blueprint for our life itself. So we also call it the financial architecture, which is required to achieve whatever you want to achieve in your life. So structure it, I mean, because it's a architecture, it provides the structure, discipline, and it gives you the most important thing which we claim to our clients is that we deliver clarity and peace of mind. So that's the most important byproduct of having a plan, knowing that your goals will be achieved and knowing that you will be financially well funded in retirement, and you will have a wealth to pass on even to your, uh, other nominees. So I'm getting into typically what happens with money, how people tend to manage money. So people tend to think in terms of investment and product, which is again, surprising actually, because money is not, there is finances is not about investments and products. What should actually come in front should be to understand what is that we need to invest for. So without understanding that, if we are actually getting into certain investment instruments and products, we will be getting into the wrong one, and probably we may not be considering the tenure or the risk or other aspects, returns and other aspects we may not consider. In fact, I would say people consider only one aspect, which is returns, to the exclusion of everything else. So which is not exactly the right way. So this is one of the typical mistakes that people tend to make. We tend to replicate what others are doing because this is not a very interesting area. Unlike most other areas, this is not a very interesting area. It doesn't draw people to it ever. So that is what we have generally seen. So this is a problem. So the easiest heuristic for a lot of people is to simply do what your friend is doing or what your brother is doing or what somebody else, a colleague or somebody else is doing, or what you see in the paper. So it's very easy to do what somebody else is doing, and which is probably not the right thing to do, because each person's situation is going to be different, and what you do in your case should not be exactly the same, considering that your situation can be substantially different from somebody else. The other typical thing which people tend to do is that during the course of the career, we tend to be in multiple places. Okay, and even if somebody is in the same place also, we tend to engage with multiple vendors. So maybe there is a bank, maybe there is a distributor, maybe there is a wealth manager, and so on and so forth. So there are so many people through whom it has been invested, and there is no one place where we know what we have invested. So this becomes a bit of a problem. And the last point, the way we manage finances is there is a kind of a short termism in terms of how we look at uh, the money that we have invested. So we are investing today, and people want to flip it in 2 months, 6 months, 1 year, and so on. So we need to really look at what we are investing in, and we need to understand that it takes time. Certain products take time. Like for example, equity is a long-term product. In fact, many of the products which have a cycle, let us say real estate or gold, these also follow cycles. So any product where there is a cycle, you will have to give it enough time for it to actually go through the cycle and deliver returns over a period of time. So we need to give it appropriate time. We need to understand the typical cycles of whichever product we happen to be investing. So let us talk about a few myths and certain ideas that people have which may not be accurate. So a lot of people tend to invest in instruments which give the highest possible returns. So that is precisely why people gravitate towards equity. Inside equity, people gravitate towards day trading, option trading, and things like that. I mean, day trading, option trading is all fantastic to talk probably in a party or maybe regal friend to friend. But that is not the way to make money. I mean, these things typically, if you are buying in the morning and selling in the evening, that is called speculation. It is not investment. So, I mean, that is one. And secondly, highest possible return. I mean, typically what happens is people start chasing the instrument which is starting to rise, and they get into that instrument and probably get into that at the wrong point. So they don't catch the right point, and then they exit at the wrong point. So which means that they don't make money. So it is very, very difficult to actually catch the, I mean, lowest point and exit at the highest point. So the most important thing which we always keep saying is that you have to be invested to ride the cycle. So first of all, understand that what is the asset mix that you have to have, and if you have that asset mix, and if you have that particular product which is actually on an upcycle, you will anyway participate in the upcycle of that product. You don't have to necessarily come into the product at the time when the product is actually going up. Chasing fads resulting in churning of investment, I think that is covered in the previous one which I said. So for example, when gold is going up or when real estate is doing well, so a lot of people actually jump into that particular product. And sometimes the fad can be it may not even be a proper investment instrument. In the past we have seen emu farming and teak plantation and various kinds of things have caught the fancy of people, and they start going into that without really truly understanding what it can really offer and what is the potential return. Then a lot of people also tend to think that timing the market is very, very important if you really want to achieve good results with your investments. Timing the market is extremely difficult. I mean, a lot of fund managers themselves say that timing the market is virtually impossible. Okay, sometimes you time the market, I mean, at certain times, and it is fortunate, but normally speaking, timing the market is extremely, extremely difficult. In fact, I don't have that slide right now, but uh, I mean, one of the slides which I've seen long time back, which says that if you have missed the 15 important days, your investment returns will be something like 50% of what you are currently getting. I mean, had you not missed the 15 important days. So which of those 15 important days, which are those 15 important days, we don't know, and we will know only with the benefit of hindsight. So the most important thing is stay invested and participate on all the days in the market rather than really timing the market. The other thing which we have generally seen is that people are unwilling to come out of the wrong investment ideas. So it is but natural. There are certain things which may have worked. There are certain things which are currently not working, and we really need to be sensible about this. Uh, we need to be willing to exit out of investments which have run the course or which have proved to be wrong. So coming out of the inappropriate investment is one of the things that we need to do. Taxation implication, post-tax returns are things which people don't really get. Like for example, in the case of an FD, I mean, most of the people talk about the pre-tax return, okay, 8%, 8.5%, and things like that. It all depends on where you are in the as far as your tax slabs are concerned. So if you are in the 30% or more tax slab, you end up getting five point something when the returns are actually 8%. So you need to understand whether you're actually beating the inflation or not. what kind of tax implications are there in the particular product. Is it capital gain implication? Is it income tax implication? If it is capital gain, what kind of return are you going to get after the capital gains tax? So it's very, very important for us to have a portfolio which is simple and easy to manage. So diversification is important, but diversification does not mean having, say, 40, 50 mutual funds in the portfolio or having 100 shares in the portfolio. Good diversification can be achieved in less than even 10 schemes. I mean, the schemes have to be appropriate to your situation. I mean, I'm taking the example of a mutual fund. Even if it is other products also, the diversity should be achieved by a simple manageable portfolio. I mean, too many components need not be there in a portfolio, which will make it very difficult for you to handle that, manage that. You please have to understand the long-term implication of your actions. Like for example, suppose we go in for a insurance product. This has implications for you for the next maybe 15, 20, 25 years, because you have to pay the insurance premium for that long a period of time, and you have to wait for the returns for that 15, 20 years. So similarly, if you are investing in a product which is not really very liquid, like a piece of land, that particular product will give good returns only over a long period of time. You have to be in that particular product for a long period of time. So you need to understand that certain products, certain actions which you're taking, you may have to give it time. Okay, you may have to understand that. Tenure and liquidity needs. I mean, so in a situation where we are looking at investments and products, we tend to ignore the tenure and liquidity needs. Like for example, I had a case of somebody from Delhi region. He had a very big corpus. I mean, something like 25, 26 crores. But he was saying he wanted to come to us for financial planning. In fact, he was talking about a particular problem that he had. So the problem that he had was that he wanted to send his daughter abroad. I mean, with so much of such a portfolio, he definitely could afford. But what he was saying is, see, I am completely stuck. We want to do financial planning. Can you tell me how to send my daughter abroad? Because my entire portfolio is stuck in land assets. So, I mean, of course, we were not able to really tell him anything, because when you have something which is illiquid, there is no real way out. I mean, probably you can, uh, against the land, you can take a loan, but ultimately it's a loan. I mean, so you'll have to take a loan and you have to send the daughter abroad, which I believe is what he eventually did. So it's very, very important not just to have money. You have to have the money in appropriate buckets, so that as and when the goals come, you will be able to liquidate that and use it for whatever goals you have in mind. It's always appropriate to consider the risk profile and make the investment which is in line with your risk profile. Like for example, for retired people, we tend to give not more than 40% in equity. It can be as low as even 5-10% in equity, because in the for a retired person, capital preservation is a very, very important thing. And quite apart from that, uh, there is another thing called, I mean, the innate risk taking capacity of a person. There may be two people who are, let us say, 30 years old, for example. One person may be extremely risk averse, and for that person, we have to appropriately give instruments which are in consonance with that risk profile. And another person who is also 30 years old can be very aggressive, and considering that they may have 20, 25, 30 years to retirement, potentially they can take a very aggressive stance as far as their investments go. So we have to necessarily look at what is appropriate for us. So that is precisely why we cannot really copy what, let us say, a colleague or a friend or a relative does. And what we need to do should be appropriate to our risk profile and our requirements. So let us come to the basics. Till now, I've talked about all the myths, mistakes, and things which people do and stuff like that. Now I'm actually going to talk about what is that you really need to do as far as your financial plan. So please give some attention to this. So the first thing that we suggest to people is we need to create a stable bedrock of investments. So a lot of times what happens is people don't have enough money, and that is when they get into the spiral of loans and borrowings. So first and foremost, you have to have a stable bedrock of investments. So for a young person who is starting their career, this is the first thing that I tend to say. Lot of young people say that, okay, you are talking about a stable bedrock. So stable bedrock means debt oriented instruments or anything that is not really very volatile? The answer is yes. Because for a young person, especially for a young person, there are going to be lot of goals and requirements which are going to come after they get into an employment. They may want to buy a mobile, they may want to buy a laptop, they may want to go on a holiday, they may want to give gifts to their near and dear ones, and so on and so forth. Each one of them may not be very high value. I mean, at least not running into several lakhs, but each one of them will require some amount of money from their side, maybe 10, 15, 20, maybe 50,000 rupees. So we need to create a stable bedrock and build that liquidity which is required for whatever you really want to do going forward without getting into the uh, spiral of loans. So all these three things are denoting some portion of that, and you need a certain amount of liquidity like I have mentioned here, so that, I mean, if there is any kind of a disruption regarding expenses or any disruption in terms of income, the liquidity will really come in handy. For anybody who's into a stable kind of an employment, the kind of liquidity what we suggest is between 3 to 6 months of their expenses. Okay, then the goals need to be prioritized. So a lot of us want to achieve a lot of these goals in the real near term. So if all the goals were to bunch up between 3 months and 3 years, it's going to be rather difficult for us to I mean, take care of all the goals. So you need to find out which goals are really important, which need to be done right away, and which goals can be slightly postponed. And over a period of time, all the goals can be achieved. But you need to actually make up your mind which is the real high priority goal, which should come now, which should come 6 months later, 3 years later, and so on. So that's very important. The most important thing I would want to say to everybody here is the most important thing to keep is the expenses in check. We need to look at what is controllable and what is non-controllable. The one that is controllable is expense. The one that is controllable is your goals. The one that is controllable is how much are you willing to keep aside every month from the income that you're earning. So one of the things that you really need to focus on is you have to keep the expenses in check. In fact, income does not really play such a major role as it is generally believed to be. The most important thing is expenses and goals. So please keep that in mind. As a financial advisor, I'm telling you a very, very important thing which is fundamental to I mean proper financial planning. Taking loans, absolutely, when it is necessary, you can definitely resort to taking loans. At the drop of the hat, you cannot take loans. Today, I mean, in Amazon, if you want to buy a shirt, also you get a six EMIs. So today, taking a loan is very easy. Taking a loan being easy does not mean that you have to resort to taking loans. So absolutely, when necessary, when there is a medical emergency and you happen to not have appropriate money or a medical insurance, in those kind of situations somebody may have to take a loan. So I'm really talking about emergency situations, and in emergency situation also we really talk about a contingency provision. So in a contingency provision, let us talk about a time like COVID. So in the case of a COVID like situation, I mean, nobody knew that a COVID like situation will ever come, and that is the whole point of a contingency. You never know when something will strike you, and for that particular point also you can always be prepared. And for that we normally suggest a contingency fund. Contingency fund, there is no one way of actually determining how much it should be, depending on what is the contingency you envisage. Okay, like for example, there may be elderly people in the family, and you know that at some point in time maybe medical emergencies can come for them, and you also know that they don't have a medical insurance policy. So, I mean, putting aside an appropriate sum like maybe 5 lakhs, 10 lakhs, वगैरह, can actually really help. And the really unknown, those kind of contingencies, if you really want to keep aside, I mean, you can estimate an amount and you can always keep aside something for your contingencies. Whatever loan for contingencies, if you don't have that money or if you have taken a loan for something else, at least ensure that you have enough money to service the loans comfortably. That is the first important thing. And there are no shortcuts as far as financial planning or wealth creation is concerned. There are a whole, I mean, blizzard of investments which are of a speculative nature, which are available today, they tend to lure you away from the straight and narrow path. It is always better to stick to good quality, high level, good instruments instead of getting into speculative assets. If at all you want to really speculate, earmark a small portion of your overall portfolio, which may be, say, maybe 1 to 3% of the portfolio. That portion which will not really affect the overall direction of your financial plan itself. So small portion, maybe 50,000, 1 lakh, some small amount if you want to put aside for any kind of speculation or speculative investment is okay. But keep it ring fenced and keep it at that. So the other very, very important thing, this is actually the nuts and bolts of financial planning again. Starting early, starting really early is the key to accumulating good corpus and ensuring that all your goals will be met at appropriate time without any problem. Even small amounts in the long term, I'm going to show you some charts. Even small amounts over the long term can actually create tremendous amount of assets for you as the income increases. A lot of people tend to tell me that, okay, I'm earning, say, 30,000, 40,000 at the beginning of the career. You're asking me to put aside even from that amount. The answer is yes. Anybody can put aside 10% of their income, even at a very, very basic level. So I don't think that is something that one can compromise on, even at the absolute basic level. You have to get into the habit of putting aside some money right from the beginning. And as your incomes go up, the expenses as a percentage of the income starts dropping, and your potential to put aside more and more investments is always there. So as soon as your income increases every year, ensure that your expenses don't increase that much and increase your investments. So that is what is going to create that asset pool that will be helpful for meeting your goals and for wealth creation. And learning a bit about personal finance is extremely important. There is no point in actually running away from personal finances. A working knowledge of personal finance, about products, about investing, about compounding, and about all other things, finances, is very, very important for people to at least take the basic appropriate decisions. Investing in products is not planning. I have told this before and I am reiterating that right now. Planning is creating that blueprint and working towards a particular end, following the blueprint. Investment is a way to give shape to that blueprint. Okay, investment per se is not planning. So now I'm going to show you 5 different charts to illustrate the power of compounding and various other things. So in this particular chart, if you were to see, just a minute. So in this particular chart, if you were to see, if a person were to start at age 25 and invest for 15 years, that is, somebody is investing for 10,000 rupees for 15 years and then leaving the investment till 60. So if a person starts at 25 and invest till 40 and then leaves the investment, then what will happen is that person is going to get at 11% a 3.67 crore corpus. 10,000 rupees for 15 years, and after that he is leaving that. 3.67 crore is the corpus. The same person does not start at 25, they started for 35 and investing till 50. Now instead of 3.67, it comes down to 1.29 crores. Now if the same person is starting at 45 and invest till 60, this person has 45 lakhs. This amount, 45 lakhs. So where is 45 lakhs? Where is 3.67 crores? You can see the power of compounding in this slide itself. I'm going to show you the next one. In the next one, the previous one was investing on a SIP basis. In this case, it is investing on a lump sum basis. So if you put a 1 lakh amount for 10 years at 11%, it gives you something like 3 lakhs. That is 3 times the investment. 1 lakh lump sum goes to 3 lakhs. If you were to give that to time for that investment for 20 years, instead of 3, it's more than double, 7 lakhs. And the same investment, if you are not touching it, it becomes 21 lakhs, which is 21 times. So that is the power of time. I mean, you have to give time in your investment. Rate of return is only 11%. I assume only 11%. It's possible that your portfolio can give higher returns than 11%. But even at 11%, I mean, see the kind of return it can give. And this is only that 1 lakh rupees. Okay. So now this illustrates how much you can actually benefit by starting early. Then there is a constant SIP throughout the tenure. If you do a constant SIP for 10 years of 10,000 rupees, you end up with 21, 21 lakhs, 22 lakhs, almost 22 lakhs. If you continue that 10,000 SIP for 20 years, you end up with almost four times of that, 87 lakhs. And if you continue that for 30 years, see the amount. I mean, it's phenomenal. I mean, it is some 12, 13 times of what you started with. I mean, that is 10 years and 13 years, it's some 13 times. Again, the power of compounding. Now, another way of looking at it. So this is actually slightly realistic. You start with 10,000 rupees. You increase by 5,000 rupees every year, because which is possible for many people. Okay, this is just an example. It can be 2,000 rupees, 1,500 rupees, 10,000, 20. It can be, the increase can be anything based on your income. But this is just to illustrate that wherever you start, as and when the income goes up, if you keep on topping up more and more money as it is feasible, the amount will be mind-blowingly high. To illustrate here, we are starting with 61 lakhs for a 10-year period. If you do this, you go to 3.51 crores if you stay invested for 20 years. That is, you are continuing to invest 10,000 and 5,000 incremental every year. Meaning, first year is 10,000, second year is 15, third year is 20, fourth year is 25, and so on. Okay. And if you continue to do that for 30 years, you are going to end up with a princely sum of 13.2 crores. This amount. I mean, all this looks almost impossible, but that's the power of compounding. And lastly, I want to talk about inflation. Inflation is the reverse of your investment, and this is also going to eat away, and you need to be aware about this particular thing. I'm going to illustrate with one example. Let us assume, as of now, you are spending something like 1 lakh per month. I mean, again, somebody can be lower, somebody can be higher. I've illustrated all that. Somebody lower, somebody higher. I've illustrated 70,000, 1 lakh, 1.3 lakhs. I've illustrated that. But that 1 lakh investment, 1 lakh or 12 lakh spending today, in 10 years it doubles. It's 24 lakhs. Okay, in 10 years. In 20 years, it becomes 46, meaning it's almost four times. Okay, what you are able to buy today at 12 lakhs, you will require 46 lakhs in a period of 20 years. And in a period of 30 years, you will require about seven and a half times of that figure, 91 lakhs. So we don't really understand how almost in a geometric progression this actually goes up over a period of time. So for a person who is spending 12 lakh rupees today, okay, and he wants to meet all the expenses for a 25-year survival period, which I have shown here, you require a corpus of 20 crores. I mean, this looks impossible. Nobody has 20 crores, but I'm talking about today's scenario. Today, if you are having 12 crores, sorry, 1 lakh rupees of expenditure, and after 30 years, you want to start living at the same level of lifestyle, and for 25 years survival period, you will require 20 crores. I've done the math, I've checked it out. Even I was very surprised. The math is correct. Okay. So we don't have to worry about this. We need to start planning about this. So that is what is very, very important. Okay. So now I'm going to talk about basic product categories. We know about equity. Lot of people want to invest in direct equity. People tend to think that managed funds like equity mutual funds and other things cannot give the returns of direct equity. It is true only if you somehow have the God-given power of picking only the right ones which in the future will be multi-baggers. But even seasoned fund managers are not able to do that. So you are probably well served by investing in simple managed funds like equity mutual funds. Today you have index funds where you don't really even have to manage the funds properly. Even the fund managers don't play a role there. They simply mimic the index, underlying index, and they have the same proportion of the various equity in like the index in their portfolio. So, I mean, let us not get sidetracked by the lure of direct equity. Let us also look at the managed fund, which is actually good enough for most people. Fixed income, FDs, bonds, NCDs, these kind of things are actually very well known. In fact, small savings investments like post office time deposits and NSE, these kind of things are actually have been there for 50, 60, 70 years. Even PPF is one of the all-time favorites, and for all the right reasons. Senior citizen savings scheme is a favorite among people who in the retirement stages. So these things are there. Apart from that, debt mutual fund is also one of the products which we need to also keep in mind, because debt mutual fund is a very diversified product. It gives a very good diversification and similar kind of returns as, let us say, an FD or a bond. Then you have real estate. Most of us tend to directly invest in residential or commercial, land parcels. Some people do invest in commercial real estate, but those people who want to invest in high quality grade A commercial real estate can look at REITs. So now REITs have come into being in India for the past 10 plus years. And some four REITs are there, and the fifth one is now, I think, about to come. Gold again is a very favorite. Real estate and gold are instruments which our people have been investing for millennia. And gold, typically we have been investing either as bullion or as jewelry. Typically, that is what we have been doing in the past. However, you also have gold funds, you have ETFs, you have now Government of India has come up with its with this sovereign gold bond. So these instruments are also available now. So which way you want to invest as far as gold is concerned is left to your discretion. But obviously, the financial portions of the gold instruments are better, because you don't have to worry about the purity, you don't have to worry about the insurance of the physical gold, you don't have to worry about the making cost, you don't have to, and even in the case of, for example, sovereign gold bond, whatever is the price of gold, whatever is the gold appreciation, you don't have to pay even tax on that. So there are some very, very positive things as far as some of the financial gold instruments are concerned. We need to consider these kind of products. We cannot really have an ostrich approach where I've been traditionally doing only this bullion, I've been traditionally only investing in residential or FDs or something like that. We need to keep an open mind on that, and that is exactly why I said that you need to read up a bit on finances, understand what is happening today in the market, and what is really, really appropriate in today's situation. Others like crypto, art, wine, this is not for everybody. I would suggest you to simply skip that as of now. So the other things are liquidity, retirement, and debt portion. So for liquidity, normally people keep money in the savings account. It can also be in flexi deposit. Many banks offer a flexi deposit where you can, where your money above a certain amount, let us say 50,000, will automatically go into a flexi deposit and sit there till the time you require that money. You have liquid funds, ultra short term funds, and arbitrage funds in mutual funds. Very good parking slots for short term funding requirements. So that is something that we can really consider. We don't have too much time to go into that. So let me not talk about the particulars of these instruments. Then we have debt investments. I mean, some of them are known, like FDs, bonds, NCDs, small savings. These are known. I talked about that. Then in terms of mutual funds, we have a whole panoply of debt investments, starting from overnight funds to short term to long term corporate bond funds. I mean, you have the entire gamut of investment options in debt mutual funds also. A lot of people are not really currently looking at debt mutual fund. They are either going to equity or they are going to traditional assets like FDs when they consider debt. They are only considering FDs and bonds. So debt investments, that is from the mutual fund stable. is something worthwhile considering. Then as far as the retirement is concerned, of course, other investment options which we talked about, equity, debt, gold, and all other investment options are credible investment options. But there are specific investment options which are really tailored for the retirement funding. One of the options is employee provident fund itself for those of whom who are in employment. For those who are not in employment, who are creating that investment corpus for themselves, PPF is an appropriate investment option. Then you have NPS. Then you have NPS. NPS is National Pension System. So National Pension System has come into being from 2004, around 2004. It's a very credible option which gives you equity, debt, and today even alternates. It gives you that access to that. It allows you to invest wherever you want appropriately. So that is something that you can actually invest properly from the retirement point of view. Just give me that. Give me your. Then you have pension plans coming from insurance companies. So pension plans from insurance companies are also appropriate instruments you can consider. But my favorite is NPS, because NPS has all the benefits of a pension product. But so some of the downsides of the typical pension products, it does not have. For one, it allows you to have complete control over where you are going to invest. Some of the unit-linked pension plans also have that control. But one more additional option here is that at retirement or at age 60, you will be able to take out something like 60% out without any taxation, which is not the case with a typical pension plan, where you can take out only about 33%. Okay. So NPS is a good one. I'm not really running down the pension plans from insurance companies. I'm only saying that NPS is a very credible option. Okay. So now I talked about the goals and the priority of the goals. It's very, very important for us to have it sorted in our mind as to which of the goals are important from our point of view, and which of the goals are medium term, which of the goals are good to have. Okay. Very important goals, I mean, for most people is house purchase. Uh, Retirement is a very, very important goal. I mean, incidentally, retirement is the only goal for which you cannot get a loan. Okay. For everything else, come to think of it, you can actually take a loan and pay it back later. Retirement is one of the goals where you will not be able to get a loan. So you have to be extremely careful. And retirement is a goal which is going to run for 20, 30, 40 years. So we have to give it the priority that it deserves. So it's very, very important. We have to start from day one. Less important but still required could be a car or a bike or whatever else you want, maybe a vacation. All those things are good to have, but not must have. Sorry, yeah, less important. So good to have is a holiday home. For example, some people talk about a holiday home or a farmhouse and things like that. So they are all essentially good to have. People also talk about a second home. So these are all good to have. So you need to really pay attention to the high priority goals, and then uh, save enough for the high priority goals first, and then you have to go down the priority ladder and see which of the other goals we can actually achieve over a period of time. Very, very important is to have appropriate security nets. I mean, you must have all gone to a circus. There is this trapeze act where I mean, a person performs on what is called the bar. I think it's called the bar. So they perform at the top. I mean, one person goes from one end to the other end, swinging from one side to another side. Another person comes from the other side and swings and catches the hand of the other person. So it all happens at a height of maybe 50, 60 feet. So now if the person were to fall, there has to be a security net, and most of the circuses have a security net. If at all the person falls, there will be something to take care of that person who is falling. So similarly in life, you never know when we will require the security net. Life is never linear. So you definitely need that appropriate security net. And for people who are in the phase where they are earning and they have a lot of goals which are coming up in the future, who have a family and a lot of aspirations, we don't know, right, how long we are going to live. We are all mortals, right? I mean, we tend to think that we are all going to live for eternity, but the sobering fact is that we are all mortals. So the point is, we don't know. I mean, whether we'll survive till 35 or 45 or 95. We don't know, right? And that is precisely why we need a life insurance, so that in an unfortunate event, the family will be well protected. So you need to take an appropriate amount of life insurance to give a appropriate good security net to the family. So in a event where the income stops, the family's goals and aspirations and other needs, and including the retirement needs of the spouse, for those people who have a spouse, it has to be properly taken care of. Life insurance is very essential. Even more essential will be a proper medical insurance, because life insurance is something, probably it's a one time event. A person may survive or the person may pass away. In the case of a medical situation, that can happen multiple times in one's life, and we have all experienced that, right? It can happen to one person, it can happen to another person in another year, it can happen to multiple people in the same year. So medical insurance is extremely critical, because medical costs have gone up. I don't have to really get into that, I don't have to explain that much. Medical costs have dramatically gone up, and if you do not have an insurance, your savings will be cleared out. So we need to have an appropriate medical insurance right from the start. Let us not really have a small amount of insurance just to, okay, tick mark that box saying that I also have insurance. That is not really going to be very helpful. If it is possible to cover the parents or the dependents in the medical insurance, dependents, I mean maybe brother, sister, or other people, it is appropriate, because ultimately, if one person is actually shouldering the responsibility, it may be a good idea to cover even the parents and other dependents in a medical insurance. But it is not always possible. So if in certain situations where the employer given policy covers the parents and parents-in-law, so in that situation, if it is possible, even if somebody has to give a certain premium, pay the premium out of their pocket, it may still be a very, very good choice to do that. I'm saying specifically employer given policy, because the regular policies, it may not be possible for the parents or other elders in the family to take part in that, because there is an age for a person to come into a policy, which typically is about 65 years of age. And if the person is beyond that age, it may not be possible for a person to be co-opted in a policy. And more important, that person, even assuming the insurance company allows it at age 70, the policy premium will be astounding. So it may not make too much sense for uh, getting a policy for somebody who is advanced in age. Employer given policy actually solves that problem brilliantly, and for a very small amount or no extra premium, it typically tends to cover. So this is the beauty of a group insurance policy. The other thing is, we need to avoid mistakes and blunders. Mistakes and blunders sets us back by years. Okay, one mistake, like for example, taking an inappropriate insurance plan, or buying some land which you are not able to sell later on, or any other investment policy where you've got stuck. These are all blunders which are typically committed by people who don't take proper counsel. So don't take, apart from this, don't take loans to spend on vacations, gadgets, etc. I mean, this is a typical blunder which a lot of people tend to commit. If you don't have the money to go on a vacation, or if you don't have money to buy a gadget, I mean, why are you buying that in the first place? I mean, you first have to save. I mean, I'm not against vacations. I'm not against people spending on whatever they want. But I mean, can we not wait for maybe 6 months, 1 year, 2 years first to save that money and then spend it? Can't we give ourselves that much time? I think otherwise you will get into a loan spiral. That is why I'm just highlighting this. Buying properties at the start, this may look like a wrong advice from a financial advisor. Buying properties at the start is absolutely should be a no-no, because a lot of people, a lot of parents give the advice to their wards that you buy a property, otherwise you are actually wasting your money. But I mean, if you are indisciplined, anyway, you are not going to go anywhere. And buying properties at the start and may actually suck up a lot of money. A lot of people in pursuance of their career may go from place to place, and one property bought at one place may help probably an indisciplined person to channelize money into a property. But again, it is not going to help the person, because the same person will go to another place and will have to rent out, and they will really struggle, because in one place they may have to pay an EMI, and another place they may have to pay a rent. So the appropriate thing to do is be disciplined, save the money at an appropriate point at a later point in time when the time is appropriate. And I would say, as a financial advisor, that appropriate time is late 30s and early 40s for buying a property. I mean, please pay attention to this. Lot of people will say that you have to buy the property early. I am not from that school of thought. I would say the property has to be bought when you have a family, you have children. I mean, for those of you who are going to start a family, and you know that this is the place I'm going to be, or right from the beginning, suppose you are absolutely sure that this is the place. I'm from Mumbai, I will be in Mumbai, I will not go to any other place. I want my house here in Mumbai and I am at 25. I want to put my money upfront. I want to buy the property. I mean, if you are so sure about everything, probably for you, buying a property at the initial stage may be appropriate. Losses from the past cannot be recouped. This is a blunder which people get into. We had a client of ours. He had lost a lot of money, some 15, 16 lakhs in a failed venture. And he came to us and he said that I don't have money now. I've lost this much money. Can you suggest me something by which I can recoup this 15, 16 lakhs in a matter of next 2 years or so? See, what is in the past is in the past. We cannot really go back and correct that. We will have to see what we can do to rebuild the future. I mean, losses from the past. So this is mental accounting, and that mental accounting will not work well. Stay with the strategic asset allocation. This is something I had mentioned in the past. You have to find out right in the beginning what is the asset mix that is appropriate to you. What your friend is doing or what your relative is doing is not appropriate for you. It is appropriate probably for them, not necessarily for you. They may invest, let us say, a big preponderance of their portfolio into equity, maybe say 80%, 60%, 85%. But for you, considering that you have a lot of goals coming up, a lot of these will be pass through assets which will be in debt instruments, and maybe a comparatively smaller amount, maybe like 30, 40%, maybe in equity. I'm just giving an example. So the strategic asset allocation in each case can be completely different, and we need to look at what is appropriate. And strategic allocation is all about what is appropriate for a particular person, given a certain risk profile, given the tenure needs, liquidity needs, when the goals are coming, how many years to retirement you have. It depends on all that. Enhancing the lifestyle over time is the appropriate thing. A lot of people tend to actually overdo on this particular thing, and they get into this loan spiral. Maintain a low profile. I mean, unwanted attention is not something that we want. I mean, a lot of people, I mean, I don't want to use the word show off, but that is what they tend to do certain times, and that attracts the wrong kind of people. And I mean, people are asking for money. I mean, so when you maintain an extremely high profile, you will attract all kinds of people, and typically people get into the spiral of giving out money in the form of loans. And I know countless people who have given loans, and then that does not come back, and it ruptures relationship. I mean, can you beat this? I mean, you are first giving money to somebody known to you, maybe your friend, maybe your relative, maybe somebody, and you have lost your money. And when you actually go and ask for money, it ruptures the relationship. The person is very upset that you have come back and asked for the money that you have given. They say that, okay, if I had money, will I not come and give you back? I mean, how come you are asking for this money? So the point is, I mean, be sane about it. Don't get into these kind of unwanted transactions where you will be at the loss and you will also rupture relationship. The other thing which I've seen time and time again is people sign sureties for multiple peoples with very, very good intention. I know a particular case where this gentleman had signed for his colleague, and I mean, she's a very, very good lady, but for some reason she fell on bad days and she was not able to pay her loan. And lo and behold, the loan agency came uh, behind these two people who had signed sureties, and he had no other option. I mean, the lady profoundly apologized, but he had to pay the money. So the point is, surety is not something that you need to sign for anybody at all. It is better to give loan and forget that loan instead of signing surety for a very high amount uh, and later on repenting that. Right temperament, think long term as far as your investments are concerned. Nothing worthwhile is, you can get it in a short term. 2 minutes Maggie is fine, but if you really want a dum biryani, you have to give it 4 or 5 hours. Long term investment is the thing. Put together a portfolio which will work in the long term. if there is volatility and lags in the returns, it is the very nature of equity or anything which has a cycle. As long as you have constructed the portfolio properly, as long as the asset allocation is right, it is with a proper strategic intent, you don't have to really worry about that. As far as investments are concerned, some investments are going to turn into lemons at some point in time. Don't worry about that. I mean, it is not about getting all the tick marks all the time. So it's okay if something has not really worked very well. Uh, I mean, change it. Simple, very simple. Ignore noise. I mean, when you open the newspaper, you will find that okay, 5 lakh crores has been wiped off from the stock market. I mean, how does it matter to you? I mean, you have a strategic asset allocation. You know what you are doing. You know that the portfolio is in the right places. Let the paper scream whatever it wants to scream. Let the friends say I've got 35% returns. Your portfolio is showing only 11% returns. Let it be. Don't worry about that. They are different people. Your needs are different, and you have a strategy in place. Ignore everything else. Invest in yourself. I mean, when you invest in yourself, you are going to put money into some educational, maybe qualification or some program or training or whatever. That is very, very important. This is actually a very benign way of investing, because what you invest in yourself is going to return hand over fist. So put money in yourself. That is very, very important over and above the other investments which you are making. Quickly keep in mind, you need to review the plan. This plan which we are creating is not going to stand you in good stead forever. We are not writing the Bhagavad Gita here in a financial plan. I keep saying that to all the people all the time. So what we are creating is with all the information available at this point in time, which includes income, expenses, personal goals, everything. Okay, and you need to review the plan because a lot of things also change over a period of time. We need to review the portfolio. In our case, we review the portfolio once every 6 months to see whether there are any changes in the environment, in any changes in the personal situation, and whether the asset allocation we have committed to the client is still right. So it's good to review. Tax saving investment, I mean, so it is becoming less and less important today because the new tax regime is upon us. But forget about tax saving investments. I will say you should start the investments, whatever lump sum investment that you want to do it throughout the year, and whatever you are getting in terms of ex gratia or bonus or whenever you are getting that, you should invest that at that appropriate time itself. Again, a reminder, don't go by what somebody else is doing. I think this is the third time I'm repeating this. It's extremely important. You have to have your own strategy. What works for somebody else may not necessarily work for you. Okay, and I have written a book called If God Was Your Financial Planner. I'll just spend 10 seconds on this. It is about financial planning, it's about life planning, personal finances, and how an advisor engages with a client in their lives. It's in an easy to read story format. You will not find it very boring. God also comes throughout the books and elucidates life philosophy itself. So if you have the time, pick up the book. It's available on Amazon and other places. So thank you very much. And this is all I have for you. Thank you so much. If you have any questions, I'll be very happy to handle any questions. Thank you so much. So if you don't have medical insurance for your parents, if no company is willing to give, I mentioned, right, contingency provision is what you have to put aside. How much contingency provision is something that you will have to decide, whether it is 10 lakhs, 5 lakhs, 2 lakhs, you will have to really decide that. So there is no one formula for that. Thank you guys. Thanks a lot. Mohammed is asking through which investment instrument. That depends. I mean, if you are talking about contingency provisions, contingency by definition is something that we don't know when it will come. Okay, it can come maybe tomorrow, it can come after 10 years, right? So it can be a mix of instruments which you can actually cash out and take out at short notice, and it can be a mix of certain long-term instruments like equity-oriented investments also. So what is the kind of mix you want is something for you to decide. Thank you, Ravi. Thanks a lot. Thank you, Manoj. Thanks, Mayank. Yeah, presentation is with NISM. They are free to share. I mean, I don't have any problems. I mean, I'll be very, very happy if a lot of people are able to see that. So very, very happy. So people who are raising their hands, I mean, if you want to unmute yourself and talk, I mean, I don't have any problem. Um, I mean, I don't know. NISM people, I mean, you want them to ask the question, uh, you please let me know if I have to answer that. Prashant, I cannot unmute you. I mean, people from NISM, they will have to unmute you.
So actually, there are many participants. You
Yeah, yeah, yeah.
can
I understand. I understand. Okay.
answer the questions
Yeah, yeah,
which
yeah.
are
I mean, there are lots of questions also,
yeah.
but only that only we have so much time. That's all.
There are
So Mohammed, investment instrument for medical expenses. Also, you can, I mean, by definition, we don't know when it will come. So I would say probably a mix of equity and debt will be a good choice. And in equity, I would say probably a hybrid kind of an investment where the volatility will be somewhat less. So that is what I will suggest because we don't know when that medical expense will be required. So from that point of view, it will be a good thing. Uh, Mir Kazim, I'm not an advocate of trading. You are talking to the wrong person, Mir Kazim. I believe in long-term investment. I don't believe in speculation. Essentially, trading and all that is essentially speculation. So I would not indulge in that. Buying health insurance, Namit, it's difficult for me to say. I can only say this much that you will have to look at, I mean, all the product benefits which you are going to get, not only the premium. So examine that properly. If you don't know, you should talk to somebody who knows about that. A few things which you have to look at is one is pre-post hospitalization. You will have to look at the network coverage. How much is there a restore benefit? Um there are so many other things also which you will have to cover. So difficult for me to cover everything here. Unit link insurance plans are good. So Shakti, I mean, difficult for me to explain like this. You will have to examine. There are hundreds of insurance products today available in the market. You will have to really examine that. I'm not here to say that unit link products are good or bad. I mean, who am I to say that? Every product is good for a certain person with a certain outlook. So you will need to really examine. Every product has a place in somebody's portfolio, right? Yeah, Mohammed has again asked which investment product is better for retirement. Someone who is 38 years old, NPS, equity, mutual fund, वगैरह वगैरह. So one thing I will tell you, Mohammed, is that see, retirement is a very, very important goal. Okay, so only with EPF or PPF or NPS, you cannot achieve that. So you require a huge corpus for retirement. So I would say all of the above. It cannot be only mutual funds, only equity mutual funds, only NPS, only debt mutual fund. It probably has to be a proper portfolio, which will include your retirement benefits. That is what I will say. Vivek is asking, how do we know when we make wrong investment? Sometimes prices decrease. So if you choose appropriately as per what is your risk profile? If you have made a wise choice in terms of which asset class and which instrument within that asset class, if you have made a wise choice, don't worry too much about the volatility. Especially in the case of equity, volatility is a very nature of the product itself. So don't worry too much on that. Stay invested. And when I say stay invested, watch that from time to time, make the appropriate changes. I mean, I talked about that in the presentation as well. You need to make the appropriate changes in the portfolio, and over a period of time, it will give good results. So, interesting question, Aryan. Rough idea of what should be the percentage of investing and expenses from our income, like how much percent should we park in it? So, there is no one answer to this. I would only say that at least you should have 10% of your income as your investments. So when I say 10%, I mean probably 90% can be expenses. That is to start with, right? So when your income goes up, when you are earning in lakhs, typically the regular expenses are going to be in thousands, maybe 40,000, 50,000, 60,000. So you have tremendous potential to put aside a huge amount of money in terms of investments as a percentage, right? Maybe a lot of people have a potential to invest 25, 30, 40%. And as you go ahead in life, in your 40s and 50s, it can even be higher. It all depends on how much are your expenses. So there is no one answer to this. You will have to keep the expenses in check. Like I said, that is the controllable. Uh, so that's the broad answer. Guys, I think that's about it. This is I've covered a broad outline of what you can do. Probably that's the netting you can probably build from that. Yeah, Prashant, you can ask me the question. Yeah, please tell me. Yeah, so here I have some other questions from the Q&A section. Um, Swarnava Sengupta. Do retirement planning required for the business person? Why? How? So, retirement planning is required for everybody, whether you are in business or ultimately all of us have to retire. You may have an opinion that people who are in business may not retire. I agree to some extent. Probably people in business may not want to retire, but for multiple reasons, including age or medical situations, people do retire, and you definitely have to have a proper retirement plan. Business people especially are prone to mixing their personal wealth along with the business. So it is very, very important for them to separate out these two and plan properly. So it's very, very important. Uh, Prerna is asking ULIP versus NPS as only 60% can be taken out. Also, lock-in is not there till 60 in the ULIP. So you will have to really see what is going to work for you. NPS is a slightly different product. It is basically created for giving you an annuity in retirement. Uh, I would say the negative of NPS is also a positive. Like you cannot really take out the money till 60. A lot of people tend to think that that's a negative. In my opinion, it's a positive because all other things which you are investing in, you can actually take out. And this is one instrument where you cannot so easily take out that money. So that money which is really sorely required for retirement, you cannot really take out. And in my opinion, it's a positive. Simplicity and manageability of the portfolio, appropriate diversification, can you illustrate? Like when I see certain portfolios, we see that there are, I mean, a blizzard of investments. I mean, made in multiple banks, uh, so many mutual funds, so many equities, so many insurance products. And so the point is now this is not giving diversification. This is only adding to confusion. So that is what I meant. I mean, if you want diversification, have a portfolio which allows you to give that, which gives you that diversification. uh, I mean, just going into every IPO and NFO, which a lot of people tend to do, is not diversification. It makes your portfolio unmanageable. So keep it simple, keep it in one or two buckets only. I mean, in the sense, one or two maybe platforms, so that it is easy for you to understand, simple to manage. That's what I was talking about. Ideal allocation for people below 30. So again, there is no one ideal allocation because, like I gave the example, a person below 30 also may have a very aggressive investment intent. That is a very high risk profile. And the another person who is below 30 may have a very low risk appetite. So we will have to invest appropriately for these two people. A person who has a low risk appetite, if I'm going to invest, let us say 60, 70% in very volatile assets like equity or any other crypto and things like that, the person will be panicking at certain points and getting out, and they'll be harming themselves. So appropriate to the risk profile is what is the investment that we need to make. It is not about just the age. It is also risk profile and risk capacity. A person who is below 30 is supposed to be having a risk capacity, very high risk capacity, because potentially this person can work for another 20, 25, 30 years. So risk capacity is also another thing that we always consider. Yeah, thank you, Vijay Shankar. My mother is 46. Medical insurance is good or not? 46 years, you can definitely get a medical insurance. Probably there will be a medical test done. I mean, not. I'm not saying it is bad. It is actually good. So she can do a medical test and she can get into an appropriate medical policy. Gauri Tangavel, instead of step up SIP, may add another SIP. Absolutely. I mean, it is entirely your choice. The most important thing as far as a SIP is, you are essentially channelizing the amounts available on a monthly basis, the surplus amounts available on a monthly basis, which in your opinion is going to be available in the future as well. You are going to invest that in a systematic, regular manner without your intervention. So that is what is SIP. So if you have the money and if you are confident that you will have the money going forward in the future as well, definitely you can definitely start another SIP. Yeah. RAT's long-term bet, long-term base, Edara, Panindra. RATs are a good instrument. This is an evolving area today. People who want regular returns, especially RATs, endeavor to give regular monthly or quarterly returns, essentially arising out of the rental incomes that they are getting. They distribute that as dividends. Okay, so it is a good instrument. If you are comfortable with a say 6.5% return on an annual basis, and certain maybe 2.5% return from the capital appreciation. If you are okay with 8 to 9% return, this could be a good product. Little bit, Jairam is saying little bit confused about diversification and asset allocation. Asset allocation is how much you are going to put in various broad asset classes, like how much in equity, how much in debt, how much in commodity, how much in real estate, how much in other assets. Okay. So that we will have to decide how much we want to put in which asset. Okay. Diversification is like, for example, um, so one is of course the asset level diversification. One is under the asset, the subcategory level diversification. Okay. So like for example, suppose I'm putting in equity and I'm putting that through the medium of mutual funds. If I'm choosing, let us say, only a large cap fund, for example, I'm achieving a certain level of diversification. But if I'm choosing a large cap fund and let us say a mid cap fund and a small cap fund, I'm achieving a much better diversification among the universe, stock universe, right? If I were to keep it very simple, I want to achieve a diversification with just one product. I want to keep it super simple. I may want to choose a Nifty 500 index fund. So that gives me diversification across the board. Now, depending on what you want to invest in, what diversification you want, what you want to achieve, you have to choose the appropriate products in your portfolio. So here, I'm a college student and I have invested 15,000 already. Right now, should I invest in improving my skills so that in future I can invest more? I would say so, because if you have 15,000, yeah, I mean this 15,000 you can always make when you have more qualifications, or in some way you are bettering the prospects of landing a good job. So yes, I mean at the early stages, I think the one that pays the best dividends is investing in yourself. Can we invest in hybrid instrument? Yeah, I mean it is contextual, difficult to say yes or no. We'll have to look at your particular case. Is term insurance better than savings linked plans? I would say term insurance. I mean, I don't want to get into this debate, but I would only say that term insurance is pure insurance. And as financial advisors, we want to keep insurance separate. Uh, a term insurance for, let us say, a 30-year-old person will be say 8 9,000 rupees only. Okay, for 1 crore per annum. So it is a very, very low cost way of protecting other people in the family. So I would definitely go for a term insurance product as compared to a savings link insurance plans. Savings link insurance plan, the problem is uh, some portion is used for insurance, and some portion is used for giving return. So if you want to take a 10 lakh endowment product, for example, you will be paying some 36, 37,000 for a 10 lakh cover. Of course, you are going to get some returns and all that. So what I'm saying is, keep these two separate, have a proper insurance which will cover whatever amount you want a cover for, and have appropriate mix of savings products which will help you to achieve whatever you want to achieve in the future. I think that's about it. Thanks a lot, all of you. Thanks so much for all the questions. Thank you. I'm not able to answer all of them. There are just too many questions. Thank you so much. Thank you all in NISM for giving me this opportunity. Thanks a lot and good day.
Yeah, yeah. Thank you so much, sir. I would like to extend our heartfelt thanks for taking time and speaking at the webinar. Your expertise, insights, and also presentation truly made a lasting impact on our audience, sir. Thank you so much, sir.
Thank